Hi, this is Grant of Fortuity Risk Analytics. Today we're going to be talking about why one European bank will dominate your portfolio. So here we have a chart of the German DAX, which is in this white line, versus Deutsche Bank. It's a one-year chart, and as you can see, there's substantial underperformance in Deutsche Bank, which is Germany's largest bank. And the reason this is important, we think it's going to impact your portfolio in the coming weeks. A lot of people are talking about how it's Lehman 2.0, but what's recently happened is we've had a little spike up down here over the last 2 weeks because apparently Deutsche Bank won't have to pay the $14 billion fine. They're only going to have to pay about $5 billion to the Department of Justice relating back to mortgage security fraud dating back to '08. And this has given a little bit of a bounce. However, one of the most important things we have to look at is their balance sheet. So Deutsche has about $15 billion of equity versus about $162 billion of debt. So that's quite frankly unsustainable. And we think it's going to get a lot worse. In talking to a lot of credit investors that we know, a lot of guys are essentially short Deutsche's stock and long the preferred, as well as long the 5-year CDS. Deutsche has actually been declining from its peak in about 2007, making lower highs. And their credit profile is actually pricing in a higher probability of default. So as Deutsche Bank slides, what we'll see here, it'll probably pull the euro down as well, forcing people to buy dollars. And you'll see the ETFs like the European banks, EUFN is the ticker, probably pull back as well as we get some pressure down with Deutsche Bank. So over the last few months, everyone has seen this chart. It's essentially Deutsche Bank overlapped with Lehman, but Deutsche Bank during 2015 to now, and Lehman obviously from 2006 until it went bankrupt in September 2008. So what's eerily similar with the chart, Deutsche Bank versus Lehman, last week we had Bank of Qatar coming out said they're going to increase their stake in Deutsche by about 25%. The market is searching for a victim. This is similar to what happened in Cyprus. Same thing with Greece over the last few years, where the market essentially forces the companies lower, short sellers pile on until eventually they need a bailout. Angela Merkel knows that U.S. elections are coming up, and she has publicly stated that she doesn't want to interfere before U.S. elections. So I think that the market is going to push Deutsche lower, and this is going to impact your U.S. equity portfolio. Credit contagion is going to spread. It's going to leak over to European banks, which will ultimately leak over to U.S. equities. So this is one of the most important risk indicators to watch in the coming weeks. If you start to see the stock push lower, it's going to translate in lower equities in North America. So here we have a chart of Deutsche Bank's yield curve. As you can see with the yellow line, the curve's starting to invert. It means investors are pricing in near-term risk opposed to further out. So they think over the next 6 months the probability of default or at least getting bailed out is a lot higher in the near term versus, if you look out 2 years plus. So as Deutsche Bank's credit profile continues to get worse, watch a lot of investors come off the sidelines, buying puts, adding to their shorts. This is one of the most predictive indicators. If this curve continues to invert a little bit more, we'll start to see more and more investors push the stock lower, ultimately leading to a bailout. This has been Grant of Fortuity Risk Analytics.